Now, this particular session, which we are going to actually continue from the previous session, the statement of financial position, or you can say the balance sheet. Understand this. Though you have the experience of, accounting, management accounting, or even if you have done many other stuff before, still you I would recommend you to just go through these basics, because if you go through these basics of balance sheet, statement of financial position, or maybe even some terminologies will be different which will be adding on in here, so that it was always good for you to develop on that stuff. Like suppose normally we call it balance sheet, but here it is statement of financial position, reports the amounts of assets and the liabilities. Now, what does comes under assets and liabilities? We're going to look at later. The equation of the balance sheet. Understand this. When we are creating a balance sheet here, the assets or the liabilities, whether you take it on the left side, right side. Let me just take a pen and start writing. Pen is there. Now, if you see in here, all right. So if you see in here, the equation of balance sheet is always like, the assets is nothing but equals to liabilities plus equity. Now if you see it here, that here is assets, here is equity and liabilities. Now when this equation comes into the picture, there are so many updates which you can actually do in here. You can do so much of stuff in here by playing with it, because you are going to get questions from all the way around, like based on this accounting equation. When assets is this much, what is the value of the equities and liabilities? What is what's the value of equity? What, like, assets minus liabilities is equals to equity, assets minus equity is equals to liabilities, assets plus liabilities, assets minus liabilities is equity, equity and liability is equals to assets. These are the stuff which you can understand. These are basic accounting equation, but still very important for you to understand. And if I just move forward here, what comes under the assets side of the balance sheet? Resources controlled by the entity as a result of past events. They represent probable economic future, termed as assets. Liabilities are present obligation of the entity arising from the past events, and which you are obliged to pay, whether it is accounts payable, whether it is creditors, and many other stuff. That's how you need to make a payment. Equity is something which people have invested in your organization, or they have paid in your organization, invested in your organization, and they are shareholders of it, also having participatory rights in the business. Those are equity shareholders or equity for the business. Understand in here, investment made through equity, you see they are nothing but the owners. Investment by owners increases in equity of a business entity. The result from transfers something of value to increase ownership interest, that all stuff. And then distribution to owners, a decrease in equity. You're buying back shares from people, you're taking money from them. In short, I hope that this is actually sounding basic, but still I would want to go through it so that you guys have some brush up over these stuff, and maybe you may find out some stuff which is new to you also. Assets liabilities are separated into current and non-current. Current is nothing, current liability or current asset is something which is due within a year. Something which is due within a year, that is your current asset or a current liability. Whereas something which is due after a year, more than a year, that is a non-current asset or a non-current liability. All right, I hope that you guys are getting clarity over it. This is the list in front of you: assets, liabilities, non-current assets, equities. Assets, liabilities, non-current assets, equity. This is not the statement. These are just the items which are possible to come into that statement of balance sheet. These are the items which can possibly come here. It's not exhaustive list, it's an inclusive list. This is not the maximum thing. There are more things also possible which can come in here. All right, now moving forward, you can see in here that what are these. You can see, yeah, under the current assets, cash, certain investments, accounts and notes receivables, inventories, prepaid expenses. And whereas in the non-current assets, certain investments and funds, like suppose this is non-current in assets is nothing but something which you have taken investment for, or something which is going to give you a probable economic future for more than a year. Okay, more than 1 year, that's a non-current asset which is going to give us future economic probable income inflows. That's future for us. Then you see property, plant, equipment, intangible assets. In short, these all stuff which we are talking about now, we are going to have it under detailed discussions in the upcoming chapters. We have six chapters in the climate material of the 2021 material, which concentrate on what? This particular external financial statements and external financial reporting. Okay, and we always do the differences of US GAAP and IFRS. Only the treatment differences we'll be doing on a regular basis. Now you see in here, equity is nothing but investment by the owners. You make the investment, that's a investment by the owners. And you see retained earnings, accumulative other comprehensive income. If you remember other comprehensive income, we were discussing it in the earlier session. We were discussing it about the other comprehensive income. And then you see non-controlling interest in a consolidated entity. Now, non-controlling interest is minority interest in a non-controlling company. Like if you see in here, in financial statements, you can find NCI, which is non-controlling interest. That's a short form for it. And also you'll find minority interest. Now, minority interest or NCI is that if you own a company, okay, if you own a company, that is like suppose Mr. A or A company holds company B, but they hold how much? 70% of company B. Now, when they hold 70% of company B, there is again 30% which they do not hold. Now, when they do not hold that 70%, that is nothing but their minority of that organization, or you can say non-controllable interest of the equity. Okay, I hope you guys are getting it. Okay, the it's separate. You need to make sure that they are satisfied and the work goes on in a proper manner. All right. I would recommend everyone to be on mute until and unless you have a doubt to ask. Okay, if you got a doubt, you can just raise your hand, or show your hand in that option is there in front of you, and even you can talk in between if you have any doubt as such. Sorry, the current liabilities, you can see the accounts payable, current notes payable, current maturities, and non-current liabilities within 1 year. Within 1 year, whichever is due, that is a current liability for you. Others will be your non-current liabilities, your non-current notes payable, which is nothing but more than a year. Even bonds payable, that's more than a year, which is to be taken into consideration. Now, an asset is classified as current, and you can see here as current on the statement of if it is expected within a year, whichever is longer, sold or within a year. The following are the major categories of current assets. What are they? Cash, cash equivalents, individual trading, available for sale goods, held to maturity debt securities, receivables, inventories, prepaid expenses, etc. Now, these all are called up as current assets. Now, there are even quick assets. Quick assets is nothing but these inventories are out, these prepaid expenses are out, and that's quick assets for you. In fact, quick assets and all are going to come in the next section, not this particular section. Ratio analysis and all, we'll be doing that too. Now, prepaid expenses are valued on the balance sheet at a cost less the expired or used portion. Now, current assets are those not qualifying as non-current assets. It's nothing but for more than 1 year, it is going to give you a benefit. It can be your fixtures, furnitures, your plant, your machinery, other stuff which is there in the organization, like suppose your computer, your laptop, your mobile phone, which is going to give you benefit for more than a year. That's a non-current asset for you. If your mobile phone is giving you benefit for more than a year, it's good enough. If less than a year, then not so good enough. Now, investments in securities made to control or influence another entity, and other non-current securities, certain available for sale, held to maturity, but for more than a year, that's non-current assets. Plant, property, equipment, you use it, you keep it in the business for more than a year, that's a non-current asset for you. Then comes intangible assets, are non-financial assets without any physical substance. Examples: patents, goodwills, and even that brand value, logo value, trademark value. These all stuff are intangible assets. Okay, like suppose there is one company which has a very good intangible asset. If I have to just draw it, there's one company. I don't know whether I'm able to draw it in the right format. This is just his logo. Can you guys help me out? Which logo is this? Sorry for my drawing.
Nike,
Yeah, Nike.
Nike.
It means that I was good enough in my drawing then. This has huge value, right?
Yes, agree.
This has a huge value if you just have proper stuff like this. If something like this, or Nike, this is Nike, or then you see another logo. That's an intangible asset for you. All right. Then current and non-current liabilities. Now, current liabilities, you see, which you are expected to, make the payments within a year. Within a year, you are able to make the payments. Within the operating cycle, you are going to make the payment. That is a current liabilities. Now, following other major categories of current liabilities, what are there? Trade payables, other payables, unearned revenues, other obligations. Now, trade payables is something you bought and said that I'll pay you after 60 days. I'll pay you after 30 days. That's a payable. That's a trade payable. Other payables from, wages, salaries, rentals, royalties, taxes. That's also payables, liabilities. Then comes one good stuff, which is unearned revenue. What it is? Unearned revenue. Now, can anyone help me out that what can be this unearned revenue and why does it come under the liability side? Anyone? Anyone? You guys got 5 seconds. Anyone can speak up. And now I'll speak it up. Shall I or anyone?
I
Like
I guess
uh,
unearned revenue is nothing but we collect the money from customer in advance before providing service to them. Is that correct?
Exactly. Exactly. That's right. You collect the payment and tell them that, okay, I'll give you the service after 1 month. Now, until and unless you give that service, you don't recognize it as a revenue. You recognize it as a liability. Once that is done, then you record it as a revenue. Because there can be anything. It can be cancelled. It can be, just asked for a refund or something like that.
yes, sir. Like we order some product and pay before, and
Exactly.
then yeah.
Until it is delivered, it is unearned revenue for them. Not only until delivered, it is also until 14 days until it is delivered, because until 14 days you have an option of refund
Yes,
or
sir.
something like that.
Yeah.
Okay, depending on it. So that's an unearned revenue arising from collections in advance of delivering goods or performing services. And other obligations, short-term notes given to acquire capital assets, payments required under sinking fund provisions. Now, let's just talk about it. Short-term notes given to acquire capital assets, you need to make a payment for it on faster basis. Payments required under sinking fund provision. Sinking fund is nothing but if you have some loan repayable or something like that. Then payments on the current portion of serial bonds, non-current debt, current portion of that loan which you have to pay. Long-term obligations are or will become callable by the creditor because of the debtor's violation of a provision of a debt agreement at the balance sheet date. Possible. Possible obligations for warranties, estimated returns, short-term leases, lease elects. These all comes under your current liabilities. Now, current liabilities do not include short-term debt if any entity intends to refinance them on a non-current basis. Demonstrate an ability to do so means if they are going to refinance it and it will not be there in the short term or in the current liabilities, it will be under the non-current liabilities only. Now, what are the notes, bonds, all these leases, payments, post-retirement benefit obligations, deferred tax liabilities on a longer term, not on short term, long term. Obligations under product or service warranty agreements, deferred revenue. These all comes under long term, more than a year. That is a non-current liability. Okay, these all stuff is going
So
to be
what is
tested.
that other other obligations? So what is that other obligation?
Other obligations. कहाँ पे है?
Yeah. So that last point of current liability.
Other obligations मतलब जो जो आपको पे करना है within a year, except
Okay.
from the above. लोन की पेमेंट करना है, जैसे कि एक लॉन्ग टर्म लोन की पेमेंट करना है, उसका शॉर्ट टर्म ड्यू है अभी. फॉर एग्जांपल आपके पास घर का लोन, यू हैव टू पे अ होम लोन रीपेमेंट. Now home loan is for maybe 10-15 years. Okay, now if it is there for 10 to 15 years,
Yes.
what happens is in that particular year whatever payments you have to make, that's a current liability for you. In this particular year what payments you have to make, that's a current liability for you, though it is all under non-current liability, but for that particular period it will come under the non-current liability,
Okay.
sorry, current liabilities.
Oh yeah, current liability. Yeah.
Okay,
Okay.
moving forward towards equity. Equity is nothing but you call it equity or you call it equity, that's up to you how you pronounce it. But here these are capital contributions by the owners or nothing but the shareholders investing in the organization. Then you see retained earnings are the accumulated net income coming in from your net profit or your statement of in your income statement. All those places your income is coming in and you're putting it under your retained earnings. Now you can see occasionally the board of directors restrict retained earnings to prevent payments of dividends. This is the usual reason board plans to reinvest the earnings in the business. Most of the time they try to do it. I guess we have few people. What do you say in organizations? What do people what do board of directors do? Do they keep their retained earnings or distribute it towards the organization or put it in the business? What happens most? Can you guys share with me? Anyone?
They reinvest it in the business.
They
Reinvest it in the business,
exactly, exactly,
clawing back profit.
exactly. What they'll do is nothing but they'll try putting it back into the business, not giving the benefit to all, just put it back in the business, put it back in the business, grow the business again and again, again and again. Retain earnings का काम ही ये रहता. Okay. Then suppose people have purchased, right, your stock, equity purchase कर लिए वो लोग, आपको पैसे आ गए उसके. The organization has got the money, they have got their share, they are going to get a dividend, the share price will rise, they'll get a benefit out of it. Clear. There can be times when I can, as an organization, go and repurchase my shares from the public to whom I have sold. That's a buyback of shares. Now, when I'm going to do a buyback of shares, that is nothing but my treasury stock is a firm's own stock that has been repurchased. Firm's own stock which has been repurchased. It is reflected in shareholders' equity as a contra account, which reduces the balance of the related account. Thus, it is not an asset. Accumulated other comprehensive income, if you see, items not included in the net income, which we discussed it in the first class. Accumulated other comprehensive income. What income can that be? Is nothing but which is not directly attributable to the daily work of the organization that it is. Okay. Now balance sheet elements are permanent accounts, assets, liabilities, equity, all the stuff which we have talked about. It is permanent account. Look, regularly they get settled in a year, then get carried forward for the next year, onward and upward it goes on. Then major balance sheet note disclosures, investment securities where you have done it. What are the maturity patterns of bond issues? What are the significant uncertainties such as pending litigation? What is the chance of getting that done? Details of capital stock issues. These all should be disclosed under the footnotes of the balance sheet. Okay, these all stuff are to be disclosed under the footnotes of the balance sheet. And if it is not done so, then it will be a big time problem for the organization, or it will not give the user confidence, the investor, the confidence to invest in that organization. After all, you need that. That's why you present all these financial statements. One of the big time user is the investor, because he's going to invest in that organization. Now, limitations of the balance sheet shows company's financial position at a single point of time, and at the end of the year, most of them बीच में balance sheets नहीं आते. Many balance sheet items such as fixed assets are recorded at the historical cost, which will not be equal today. आज के लिए equal नहीं है वो, कब की record कर लिए, सो बहुत पहले उसको record करे थे, and now it is not having that value, that fair value. The preparation of balance sheet requires estimates by the management judgment. The balance sheet omits many items that cannot be recorded objectively but have financial value to the company. So those items which are not relevant will still be there. Okay. Now moving forward, then comes our income statement, or you can also call it your profit and loss account. Okay, profit and loss account or income statement, almost the same. The only thing is here the income statement is vertical, not in a tabular format. Now, when you start with your income statement, let me just put it down in some ways so that you guys can have proper understanding about it. जैसे कि ये देखो, they have given down the equation. What it is: income is nothing but revenues plus gains minus expenses minus losses. Now, if I put down the income statement, I would want, if you guys are making notes of it, make sure that you make note of it, is that income statement will start something like this. Income statement, sales minus variable cost will give you contribution. After that contribution, you minus your fixed cost, that will give you your operating profit. And then once that's done, then next will be your, after you reduce the fixed cost, then minus your interest, operating
Interest.
profit. You also call it EBIT, earnings before interest and
EBIT.
tax. Then you remove interest, then it will be earnings
EBT.
before
Before tax.
tax. And then again after that you minus tax, then you get earnings after tax, or you can also call it your net profit. And then what you do is nothing but you minus the preference dividend, you get earnings available for equity shareholders, and then once you get earnings available for equity shareholder, you distribute it to the people at large as a dividend दे दो और अपना एक reserve रख लो. That's a typical income statement which will be there, which you will be dealing with in this complete CMA classes. You'll be dealing with that itself. Then you see revenues are the inflows, gains are nothing but any increase or any profit which you are getting, that's your revenue. Expenses are outflows or other usage of assets or incurrences of liabilities or both from delivering or producing goods, providing services, etc. Losses are decreases, loss decrease. All transactions affecting net change in equity during the period are included in the income statement except transaction with owners, prior period adjustments, item reported initially in other comprehensive incomes, transfers to and from appropriate retained earnings. These all stuff. Okay. Revenue, expenses, gains, and losses are recorded in nominal accounts because they record the transaction and events. I hope you guys know what is the rule of nominal account. Debit all. Debit all. Nominal account. What's the rule of nominal account?
Expenses and losses, credit all income and gains.
Exactly. Debit all expenses and losses, credit all incomes and gains. Do you guys agree? Remember? I
Yes,
hope
sir.
yes. All right. I hope yes, you remember.
Yes.
Okay. Then, then there is, for example, income or loss for a period is close to retained earnings at the end of the reporting period. Gross profit is the net difference between sales revenue and cost of goods sold. Gross profit margin or percentage you can see in here, gross profit divided by sales. Anyhow, this is going to come in the ratio analysis which we are going to do. But what is the gross profit margin? Is gross profit divided by sales. You will get the answer. Gross profit divided by sales. That's it. Then typical items of cost and expense. Understand this. We were talking about this particular concept, matching concept. Very, 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 very important. It's essential synonyms with associated cause and effect under the matching principle. What happens is the expense related occurs with the cost which is related towards that same accounting period. Okay. There are times in which your income should match with your expenses of that particular period, and that can happen when you have accrual basis of accounting. You can do this particular matching concept. Now, cost of goods sold, see here, this is the formula for cost of goods sold. You need to remember it for your life. What it is: beginning inventory plus net purchases plus freight is equals to goods available for sale minus ending inventory. That's it. If I have to put it under a T table, if you see in here, is nothing but opening stock plus purchases plus direct expenses
Minus close.
minus closing stock. What it is? My cost of goods sold. सिंपल. यहाँ पे बस क्या है, क्लोजिंग स्टॉक की जगह एंडिंग इन्वेंट्री है, ओपनिंग स्टॉक की जगह बिगिनिंग इन्वेंट्री है. Purchases, net purchases is nothing but affected with the purchase returns also. Then freight is nothing but your direct expenditure, that will be your goods available for sale minus your ending inventory. That is the amount of cost of goods sold.
Good soul.
Okay. For a manufacturer, cost of goods sold almost the same. It's nothing but beginning direct material inventory, purchases during the period minus ending inventory. So you'll have your direct material used in production, then direct labor, then overhead, fixed and variable, then total manufacturing cost. Then again you have that inventory which goes in cost, matlab starting ki inventory, remove the closing inventory, then you get your cost of goods sold manufactured, cost of goods actually manufactured, and same goes on. So it's nothing but here we are doing it with the finished good. Okay, finished good we are doing here, but again we are breaking it down into as the manufacturer. This can also be tested but not tested most of the times. Then share based payments and employee benefits. Share-based payments or employee benefits was first started in India by whom? Any idea? Employee benefits, share-based payments towards the employees, ESOPs. Shall I give you a hint?
Tata Group.
No, I don't think so. It's Tata. I guess Tata is doing it. In fact, everybody took it up and did it. Who started it? It's a South Indian company.
Infosys.
Exactly. That's Infosys. Mr. Narayan Murthy started it.
Okay.
What he said is nothing but to keep that employee with us, to keep that employee satisfied. What you need to do is try giving him some benefit of the work which he's doing. Not only benefit of the work, at that time they did not have that much amount to pay. They just wanted that employee to trust in us and be with us so that we can achieve what we want to. And that's the day when they came up with ESOPs, employee stock option plan. Okay, under the employee benefits. Under the employment benefits, what did happen here is nothing but when they gave this option, the shareholders, sorry, the employees were self-motivated to do work because they knew that if they are working well, indirectly or directly, it is going to benefit them. Indirectly or directly, the organization will grow. Now, when the organization will grow, the share price will grow. If the share price will grow, the employee also owns some shares, right? They'll do their best. Employee stock option scheme. Call options that give employees the right to purchase the entity share in exchange of their services. Share appreciation rights and entitle employees to cash payments calculated by reference to increase in market price. Share ownership plans that distribute shares to the employees in exchange of their services, etc. Also, compensation requires all entities to recognize compensation expense equal to the amount of fair value of the share-based payments which are granted to the employee. Now comes US GAAP and IFRS difference, which we need to learn point by point. Why? Because this is given by the law directly. IFRS 2, which is nothing but share-based payment, contains more stringent criteria for determining whether an employee share purchase plan is compensatory. As a result, some employee share purchase plans for which IFRS 2 requires recognition of compensation cost will not be considered to give rise to compensation cost under US GAAP. Whereas IFRS 2 applies the same measurement requirements to employee share options regardless of whether the issuer is a public or a non-public. US GAAP requires that a non-public entity account for its options and similar equity instruments based on their value unless it is not practical to estimate the expected volatility of the entity share price. In that situation, the entity is required to measure its equity share options and similar instruments at a value using the historical volatility of an appropriate industry sector index. In tax jurisdictions such as United States, where the time value of share options generally is not deductible for tax purposes, IFRS 2 requires that no deferred tax asset be. I hope you guys know what is deferred tax asset. Anyone not aware about it? Deferred tax asset be recognized for the compensation cost related to the time value component of the fair value of an award. Are you guys there with me? Are you guys there with me?
Yes, sir.
Yes.
Type down a yes in the chat section.
Yes, sir.
Type down a yes in the chat section so that I can see who all are there in here. One, two, three, four. I at least need 8, 5, not 8, at least 7, because only 5 people have message in the chat section. What about others? Are you guys there? Away from the system or something like that? And even if you're watching this recording, put down somewhere or the other that yes, you are there with me. Even if you're watching this recording. Okay. So now let's move forward here. US GAAP require a portfolio approach in determining excess tax benefits of equity awards and paid-in capital available to offset write-offs to deferred tax assets, whereas IFRS 2 requires an individual instrument approach. Thus, some write-offs of deferred tax assets that will be recognized in paid-in capital under US GAAP will be recognized in determining net income under IFRS. Now, here, understand this. US GAAP IFRS, slight difference. यहाँ पे देखो, thus sum of write-offs of deferred tax assets that will be recognized in paid-in capital under US GAAP. Whereas here, if you see, IFRS 2 applies the same measurement. कहाँ गया यहाँ पे? Share purchase plans for which IFRS 2 requires recognition of compensation cost will not be considered to give rise to the compensation cost under the US GAAP. That's the only difference. But this difference is not there in the direct syllabus, but still it is for your understanding, which we are talking about. We are going to talk about it much further again, the share based payments, which is IFRS 2 US GAAP, though there is no numbering given for it, but just for understanding. But still, we are talking about how do we record it in the financial statements. Other expenses, general and administrative expenses, are incurred for the benefit of the enterprise as a whole and are not related wholly to a specific function, selling or manufacturing. They include accounting, legal, other fees for professional services, officer salaries, insurance, wages. These all are other expenses which are again included into the income statement. Selling expenses are those incurred in selling or marketing, are also incurred in income statement. Interest expense is recognized based on the passage of time. In the case of bonds, notes, and finance lease, the effective interest method is used. Now, income statement formats, you can have a single step or a multiple step. Like you can see, most of the times a multiple step. Net sales, cost of goods sold, net gross profit, selling expenses, and all, which we just talked about here. Where did we do it? Yeah, here. Somewhere here, which we just did. Income statement, sales minus variable cost gives you contribution, then that minus fixed cost gives you operating profit. In that same manner, they have done it here. If you guys want to make a note of it, you're free to go for it and make a note for it. You can see net sales minus cost of goods sold gives you gross profit, and then after that gross profit, you're selling and administrative expenses. After that, it gives you your income from operations minus your other revenues or gains. Sorry, plus your other revenues or gains and minus your other expenses and losses, and then deduct your income taxes. You have your net income in place. All right. Are you guys making note of it?
Yes.
All right. Then I'll give you 10-20 seconds for it.
Yes, sir. So what is minus, what is plus in that, in this?
If it is in brackets, it's minus.
Okay, okay, yeah.
Tell me when you're done. Done.
Yes.
Everyone.
Yes, sir.
Okay. Let's continue. Now, reporting irregular items in where? In the income statement. Okay, reporting irregular items in the income statement. How do you do that? Well, discontinued operation. You can see when an entity reports a discontinued operation, it must be presented in a separate section like income from continuing operations. Then, because these items are reported after presentation of income taxes, this must be shown net of taxes. The term continuing operation is used only when a discontinued operation is reported. If reported, may have two components: gain or loss from operations, gain or loss on disposal of this component will be there in here. All right. Then discontinued operations, it's same as the income statement goes on. See, after that income taxes, what happens? Income from continuing operations, discontinued operation, gain from it, and then income taxes and gain from discontinued operation. This is the thing which will be separately added. All right, nothing else. Then extraordinary item, FASB, accounting standards update, income statement, extraordinary and unusual items, removed the concept of extraordinary items from US GAAP from both public and private companies. The separate net of tax presentation is not allowed. An entity is required to prepare separately present items that are unusual in nature and occur frequently on a pre-tax basis within income from continuing operations. And that goes where will it go? Other comprehensive income. वहां जाएगा वो. The standard took effect for fiscal years beginning December 15, 2015. Now, the major statement note disclosures: earnings per share, depreciation schedules, components of income tax expense, components of pension expense. Now, you see here, we are talking about lots and lots of theory of accounting. But once we jump in towards problems, there will be problems and theory both mixed together. Now, limitations of the income statement does not always show all items of income and expenditure. Some of the items are reported on a statement of comprehensive income, not included in the calculation of net income. Yes, these are all items which we are talking about now. These will be disclosed in the other comprehensive income statement. For example, the data from the income statement itself is not sufficient enough for assessing liquidity. This statement must be viewed as a conjunction with other statements, such as balance sheet and statement of cash flows, but it cannot talk about the liquidity. It can talk about the profitability for sure, but not the liquidity of the organization. Okay. I hope you guys are getting the difference between liquidity and profitability. In an organization, you want liquidity and you want profitability. Because if you have profits, but that's not liquid, then what's the fun in it? मतलब पैसे तो है लेकिन इस्तेमाल नहीं कर सकते. That is something which is called profits without liquidity. Both should be there. Like suppose I own a land. I purchased it at 5 lakh rupees and today it is 30 lakh rupees. I have a profit of 25 lakh rupees. But is it there in my hand? Can I use that 25 lakh right now? No, until unless I liquidate it, until unless I sell it, I cannot use it. I can record it as a profit. Okay, should I record it as a profit also? Will that make sense? So the point here is liquidity and profitability, both should be there. I hope you guys are there with me and understanding it.
Yes, sir.
Now, statement of comprehensive income. It consists of net income or loss, or OCI, which is other comprehensive income. Now, all items of comprehensive are recognized for the period in either. You can see here the effect of portion of a gain or loss on a hedging instrument in cash flow hedge. Hedging instrument, if there's a, it's kind of maybe or may not. Don't put it under income statement, put it under OCI. Unrealized holding gains, losses due to changes in the fair value of available for sale debt securities, change in value of the asset, change in value of the stock. Don't put it under income statement, put it under OCI. Translation gains and losses of financial statements of foreign operations. Where do we put it? Where do we record it? कहाँ record करेंगे हम लोग? Where do we record it? बोलो बोलो बोलो.
OCI,
OCI. Translation of these foreign exchange fluctuations, OCI. Not directly towards the net income. Why? Because it is not directly attributable to the daily operations. It's not there in the daily operations. If it is there in the daily operation, it goes towards net income. If not, then it comes under the other comprehensive income. Okay. Then certain amounts associated with accounting for defined benefit, post-retirements, all those stuff will also be in there. Now, all items of comprehensive income are recognized for the period in either one continuous financial statements that has two sections, net income and OCI, or two separate but consecutive statements. The first statement is the income statement. The second statement is the OCI. As you can see here, this is how a separate statement of OCI comes in. Like suppose this is the net income which came in from the statement of income profit or loss account. Wahan se what you do is nothing but other comprehensive income net of tax. Loss, gains, effective portion of losses, these all stuff will be accumulated and then total comprehensive income will be there for you. All right. Then moving forward, statement of changes in equity and equity transaction. Statement of changes in equity, you can see here. Each change is disclosed separately in the statement. The following are the common changes in the equity component balances during the accounting period. You can see your equity will be there, right? Your equity is nothing but your share price. What is the fluctuation in those share prices or your retained earnings? How is it going to be? Those all stuff will be there in this particular statement. Issuance of common stock, total change in other comprehensive income during the period, the repurchase of common stock, issuance of common stock, distribution to owners, net income loss for the period. These all stuff will be in here. All right. Now, this is a kind of statement of changes in equity. You can see here. Total equity 650, which is nothing but net income for the period, OCI, common stock issued, dividends declared, पैसे बाहर गए, repurchase of common stock, पैसे बाहर गए, बाकी सब पैसे अंदर आए. So what they have done is nothing but put it down in a separate format. So यहाँ पे for now it is just for explanatory purpose, but in the real problems and all, this will be much easier because how much has come in towards the equity side, how much has gone out, it is just putting down in a statement format. That's it. Okay. Then moving forward, statement of retained earnings. A statement of retained earnings reconciles the beginning and ending balances of the account. The statement is reported as part of the statement of changes in equity in a separate column. You can see here. A common example of retained earnings reconciliation: retained earnings beginning balance plus net income loss for the period minus dividends distributed during the period plus positive or negative prior period adjustments. In short, your retained earnings starting balance or retained earnings ending balance is done. Okay. Then comes in prior period adjustments. How do you make this prior period adjustments? Like suppose you have to do some prior period adjustments. What do you do it? Whether you do it on a retrospective effect or you do it on a prospective effect. A retrospective effect is nothing but suppose there is a change in the accounting estimate or accounting recording way. If it is a retrospective effect, you need to go back and change it from day one. If it is a prospective effect, you need to change it from now, and now the change affects it. Okay. However, changes in accounting estimates, change in percentage of credit sales for estimation of bad debt expense require prospective application. That is, the effect of a change in accounting estimate is accounted for only in the period of change and any future periods affected. Now, common and preferred stock. Common stock is nothing but will be straightforward equity for you. Anybody can buy it. Whoever buys it gets normal voting rights, gets ownership rights. Whereas preferred stock, okay, preferred stock is towards those people who do not get voting rights but will get their money as and when you get profit or you don't get profit. It will be compiled and then you get it. Whereas in common stock, either you get profit or loss. If there's a profit, you get the dividends and all the stuff. If there's a loss, then you do not get anything as such, because you are the owners of the organization. Whereas preferred stock is not the owners. All right. Preferred stock will get preemptive rights that at the time of liquidation, they'll get their money first. Why? Because they are not the real owners. The real owners are the common stock people. They'll get it at the end. Real owners will get it at the end. They are complete there in participation. Okay. Then next, moving forward, preferred stock also we've talked about. Preferred stock is always a cumulative. Preferred stock means agar aaj unko profit nahi mila, if they do not get a profit today in this year, then that will be piled up for the next year. It would not be like, okay, you did not get a profit, it's gone. No, that's a cumulative preferred stock always. And then convertible preferred stock is nothing but you can convert it towards a equity shareholder, equity share. Are you guys there with me? Yes or no?
Yes.
Everyone there? Put it down in the chat section. Then equity transaction, issuance of stock. If there is a issuance of stock, cash is increased. Cash is increased. Common stock account is increased. Total par value of the stock is increased. Additional paid in capital, if it is coming in, that is also increased. I hope everyone is following up. All right. Then issuance of stock, direct cost of issuance, underwriting, these all stuff will come into the place queue. Underwriting will come when there are chances that the complete stock will not be purchased. Matlab, the minimum subscription will not happen. That will be the challenge. Minimum subscription nahi hoga. Big time challenge. Okay. Balances of cash, common stock, additional paid in capital were increased by 850,000, 50,000 and 800,000 respectively. Direct cost of issuing stock, underwriting, legal, accounting, tax must not be recognized as an expense. Instead, they reduce the net proceeds received and additional paid in capital. This will happen when an issuance of stock is happening. All right. Then equity transaction, treasury stock. Treasury stock is nothing but which you buy back from the shareholders. That's your treasury stock. Okay, I don't know what happened here.